As investors and companies alike reflect on the Australian AGM season, this Minerva briefing discusses the key takeaways and trends to look out for as we head into 2022. My name is Alex Whitebrook, ESG Communications Manager at Minerva Analytics, and this is a Minerva briefing reviewing the trends of the Australian AGM season. Minerva, trustworthy data and insightful reporting for sustainable stewardship. So, let's jump right in. These are the topics we'll be covering today, starting off with a review of the general trends around shareholder voting, key governance developments, and shareholder proposals. We'll go on to discuss the major ESG developments likely to impact the market in the coming year. Average turnout at AGMs in the ASX 100 dropped again this year from 68.32% to 66.89%. Considering many companies enshrined virtual-only meetings in their constitutions as standard procedure in 2021, this outcome is somewhat unexpected. This trend is likely due to the expiry of temporary legislation introduced in response to the coronavirus pandemic that allowed meetings to be held online. In the scramble to adjust to the new normal, many companies ended up without a procedure in place. A bill to modernise the Corporations Act was introduced to Federal Parliament in October 2021, allowing for hybrid and virtual AGMs, but it was not brought into effect in time to allow for its smooth implementation. Average shareholder dissent across all resolutions considered at shareholder meetings of the ASX 100 over the last 6 years has averaged 5.7%. This indicates that shareholders overwhelmingly support management, with an approval rate of more than 94%. In 2021, average dissent slightly fell from 2020's dissent level, from 6.28% to 5.75%. In addition to lower average dissent, 2021 saw a lower number of companies and resolutions receiving high shareholder dissent, 20% or more votes against management recommendation. In 2021, 24 companies received high dissent on one or more resolution at a shareholder meeting, and overall, 42 resolutions received high dissent. This reflects a reversal from the consecutive increases in dissent from 2017 to 2020. Shareholder dissent around governance issues stayed relatively steady from 2020 levels. In 2021, 11 director elections received dissent of 20% or more, and a further 15 received dissent between 10 to 20%. Looking back, 2019 continues to remain the standout year for dissent on director elections. On the remuneration side, while a lower number of companies received high dissent in 2021, of those 14 resolutions, 13 received a remuneration strike, being over 25% dissent. Further to that issue, 7 remuneration report approvals were voted down by shareholders, a record year in terms of strikes and defeats. The results indicate that shareholders are picking their battles, as Minerva predicted in our previous report on Australia, resulting in a smaller number of high-profile significant dissent levels, but low overall dissent levels. Where opposition has been expressed, it was often at a very high level, suggesting a more targeted approach from shareholders on remuneration this year. Focusing in on remuneration strikes, just one company this year was a repeat offender from 2020, being Crown Casinos. Crown Resorts Limited received a first strike in 2020 after a regulatory inquiry was launched into alleged facilitation of money laundering at its casinos and cultural governance and risk management failings. At the 2021 AGM, around 30% of shareholders voted against the remuneration report. Shareholders had expressed concerns with almost $10 million Australian dollars in aggregate termination payments to outgoing CEO Barton and executives Barry Felsted and Todd Nisbet. Following the second strike, it is legally required in Australia that a board spill resolution be considered at the same AGM, which if passed would require the company to hold a spill meeting within 90 days to re-elect each of the directors whose remuneration was considered at the most recent AGM. Unsurprisingly, this board spill resolution was not passed, receiving only 4.51% shareholder support. This highlights shareholders' general lack of support for the spill mechanism, or perhaps support for the reconstituted board. According to Minerva's VoteWatch database, there were 37 shareholder proposals in the ASX 100 in 2021, remaining relatively stable to last year's 38 shareholder proposals. Around 60% of the shareholder proposals in 2021 concerned sustainability issues, highlighting the importance of ESG issues for Australian shareholders. Of the sustainability proposals, all but 2 considered climate change-related issues. The other 2 proposals concern human rights and cultural heritage protection. In 2021, 5 of those climate-related solutions received majority support. However, only 2 of the resolutions were carried. In Australia, due to the definition of shareholder resolutions as binding on the company, they require a supermajority of 75% to be passed. As a result, there are routinely resolutions filed by shareholders seeking an amendment to the Constitution to give shareholders the right to propose advisory resolutions or express an opinion. However, these constitutional amendment proposals remain largely unsuccessful, with only 5.82% average support over time. Without passing this amendment, any other shareholder proposals voted on at AGMs cannot be carried forward. Despite this, shareholder proposals continue to receive high support from Australian shareholders, used as a kind of warning mechanism. Beyond the patterns of shareholder voting in Australia's 2021 proxy season, a number of key ESG developments have emerged that stand to shape the year ahead. First up, Australia's Big Four banks all faced shareholder resolutions asking them to abide by their self-declared support for net zero emissions by 2050 and stop financing fossil fuels this season. The resolutions asked for a firm commitment from the Westpac Banking Corp, Australia and New Zealand Banking Group, Commonwealth Bank of Australia, and National Australia Bank not to fund any fossil fuel projects, in line with calls by the International Energy Agency. Originally filed in October 2021 by a group of about 100 shareholders, the resolutions came as a warning ahead of COP26. Australia's AGM season revealed shareholder support for the banks and against the resolutions, but their boards are on notice as regulators continue to step up pressure on climate-related disclosures. Corporate Australia has continued to face corporate culture scandals resulting in management restructurings. James Hardie Industries plc announced on the 7th of January 2022 that Jack Truong was no longer employed as CEO. The board undertook due diligence, which included an independent third-party consultant, following employee complaints about Truong's work-related interactions. The board concluded that Truong's conduct, while not discriminatory, extensively and materially breached the James Hardie Code of Conduct, and resolved to terminate his employment. Truong's dismissal is reflective of the growing importance being shown to culture and conduct at companies. Crown Resorts Limited, QBE Insurance Group, and Rio Tinto have all seen their CEOs depart in recent years due to conduct and ethical failures. Further corporate culture issues have emerged as Australia's mining scandals continue to worsen. The destruction of sacred rock shelters in Juukan Gorge by Rio Tinto has acted as a catalyst for investor action on Indigenous rights and cultural heritage protection in Australia, whilst also highlighting the material, ethical and financial risks involved. Check out our 2021 Australia ESG update for an in-depth discussion of that scandal. Further updates are also available in the full briefing below. This year, a new scandal has emerged from Rio Tinto with an independent report revealing systemic bullying, sexism and racism across its firm. The report, conducted by Elizabeth Broderick, Australia's former National Sex Discrimination Commissioner, found that most women working at Rio experienced everyday sexism, which included being left out of meetings and not being provided with a women's toilet. The report has also raised concerns about major mining company BHP Billiton. Jacob Stalsum, Chief Executive Officer at Rio Tinto, who commissioned the report, said the findings were deeply disturbing and offered his heartfelt apology to every team member, past or present, who has suffered as a result of these behaviours. This report is likely to spark great action on diversity, equity and inclusion for Australian investors, especially in the mining sector. This also comes as another of the latest mining industry scandals in Australia, due to have an increasingly large impact on future AGMs. Human rights and modern slavery have long been an important topic for consideration by Australian shareholders. In December 2021, the Australian Parliament passed legislation to amend Australia's sanctions regime to allow for so-called Magnitsky-style sanctions to be introduced, allowing extraterritorial sanctions that target specific countries, organisations and individuals. The new sanctions will increase the due diligence expectations of businesses in Australia, requiring them to ensure entities or individuals they do business with are not subject to any of these sanctions. These new sanctions come after a private member's bill to ban imported products linked to modern slavery passed the Senate in August and was introduced to the House of Representatives in November. Although the bill has not yet been passed, it comes as the latest in a series of international reactions to the alleged human rights abuses in Xinjiang, China. This year, the 10th anniversary for the UN Guiding Principles for Business and Human Rights, Australia's Commonwealth Modern Slavery Act will be subject to review. This comes as the EU has begun implementing mandatory human rights due diligence, with legislation recently passed in both Germany and Norway. It is highly likely that Australia's new sanctions law, the Private Members Bill on Xinjiang, and the EU's growing mandatory human rights due diligence scheme will have significant impacts on the Commonwealth Modern Slavery Act's review this year. making human rights due diligence a top priority for investors all throughout this year. A final and significant development coming out of the 2021 AGM season in Australia has been the horrendously bungled proxy advisor regulations put forward by Federal Treasurer Josh Frydenberg. The regulation required proxy advisors to provide their voting recommendations to companies on the same day they are provided to investors from the enforcement date of February 7th, and required proxy advisors to be independent of their institutional clients from July 1st, 2022. Advisors could have received a maximum penalty of 11 million Australian dollars for breaking the new rules. The new rules had initially been put forward in May 2021 with the requirement that proxy advisors send their recommendations to companies ahead of their clients, attracting widespread criticism. At the time, Minerva CEO Sarah Wilson publicly criticised the regulation, stating that the Australian government's proposals are an extraordinary and authoritarian attack on basic property and establishment rights, adding, "We only have to look at the effect of issuer influence over the credit rating agencies to understand that research independence and objectivity is something the markets need and should cherish." Bearing in mind that Australian boards experience some of the highest levels of shareholder support in developed markets at more than 94%, it's not really clear what the problem has been. Clearly, proxy advisors should be independent from their institutional clients where possible, but to give undue power to companies over the votes of asset managers and owners could irreparably change the Australian proxy season for the worse. However, as such advice services have become more influential, increasing complaints from company directors under scrutiny have almost certainly sparked the latest reforms from the government. In the latest twist to an ongoing saga of Australian proxy advisor regulations, the highly criticised reforms were overturned by the Australian Senate on the 10th of February, just 3 days after they were enforced. The legislation for the regulations was still on its way through Australian Federal Parliament when it came into force and was knocked down in a 29-25 vote put forward by independent Senator Rex Patrick. Although the law has been unsuccessful once again, Treasurer Frydenberg is likely to reintroduce the bill later this year after further review. Although the initial rules have been rolled back somewhat, we remain concerned that regulatory interventions continue to undermine shareholder rights and give undue deference to companies, while the real issues of ineffective cross-border voting remain unaddressed. Thank you very much for tuning in to this Minerva briefing. Down below you'll also find today's slides and a full briefing PDF providing deeper analysis of the 2021 AGM season in Australia. If you wish to find out more about how Minerva can help you improve your ESG stewardship and proxy voting, say hello at minerva.info. Thank you all for tuning in.